Well, welcome. It's good to have you all with us this evening, and we've got an interesting program here. Just as a quick review of things, here's what's on our program tonight. Firstly, we're going to do a highlight of the changes, and then we're going to go through a worked example. We're going to run through a few FAQs. We've got about 8 strategies that we'll look at. Following that, we'll have some comments from Rupert Goff, who is the CEO of TheMortgageLab. We've got a question and answer session at the end, and then last we've got some comments from Daniel Carney, authorised financial advisor from Goodlife Advice. So let's first of all get into the changes that the Prime Minister has announced recently. The first big thing is the change to the bright line test. It's increased to 10 years. So at the moment, or should we say prior to 27th March, if you had bought a house, you would have to hold on to it for 5 years. And if you sold it within that period of 5 years, it would be taxable. Now, there's various reasons why you might get taxed on the sale of a house, and the bright line test is just one of them. But the big change is that this period has now been increased to 10 years, which does bring it into line in some ways with rules for subdividing. Now, the exception here is new builds, and the bright line test for new builds is staying at 5 years. So let's just go into a little bit more detail on the bright line test changes. And what we're going to do is share our screen here to help us with that. I'll just bring it up on screen. And here we go. This one here, bright line test proposed changes. So you can see there, this sheet is on the ID website. Also, if you go to EpsomTax.com /blog, then we've got links in our blog article to these 2 fact sheets. This is all that the government has released at this stage. You'll see the first paragraph here, extension of the bright line test to 10 years. Now, one question which has come up this week is, well, does that automatically affect all properties? Well, the answer is no. If you follow the flow chart, you can see what the story is here, how it's going to work. So let's say you've got a property, it's not your main home, no, it's a rental. It says, did you acquire it before 29th of March 2018? Now, just to refresh your memory, at that time, homes were subject to a 2-year bright line test. So if you'd bought a rental property or a house to live in and it was before 29th March 2018, it's now out of bright line. And so you can see that the flow chart here leads you to this box which says the property is not subject to a 5-year or a 10-year bright line test. In other words, you can sell that and no taxable gains under bright line. But what if you've acquired it since then? In other words, you bought the property on the 30th of March 2018 or any date after that, right up until the 27th of March. Well, that's going to be subject to a 5-year bright line test. So if you just do the math, let's say you bought a property in April 2018. So that means 2019 is going to be year 1, 2020 year 2, 2021 year 3, 2022 year 4, 2023 year 5. So you'd have to hold on to that property until at least April 2023. Otherwise, if you sold it, it would be a taxable sale under the bright line test. Now, looking at properties that you bought now, say, tomorrow you go out and buy a rental property, well, that's going to be caught by this new 10-year one. So the point is, it's all based on which period was in force when you bought the property. Was it 2 years? Was it 5 years? Or are you buying it now? Therefore, it's going to be subject to 10 years. And just one little note of caution we'll talk about. You see, another question that's come up is, when did I acquire my property? And we've got a little bit of a definition here. We're not going to go into it at length in this webinar, but notice this comment: for tax purposes, a property is generally acquired on the date a binding sale and purchase agreement is entered into. And we've got a question in our FAQ section, particularly, which talks about, well, what if there was transactions that sort of they took place, a sale and purchase was signed before this date of 27th March, but we're going to use another entity to be nominated as the final buyer. We're just going to scroll down a little bit though to the examples here. And these are sort of quite enlightening in terms of what new builds are, etc. Because there's also been a lot of talk about what's a new build. You can see in this first part of the sheet here, it just simply says there'll be consultation on what will be considered a new build. It mentions things such as it's intended to include properties that are acquired within a year of receiving the code of compliance under the Building Act. So does this mean that you've got a property, it got its code of compliance 10 months ago, it's still a new build under the new legislation? Well, unfortunately, we don't know. This is just a very high level overview, and the government won't be clarifying this until the draft legislation is out in October. So a lot of interest in the last couple of weeks or queries have been around, well, my new build is underway. It's still being built. It hasn't been tenanted yet because it hasn't even got its code of compliance. Is that a new build? Well, again, unfortunately, we don't know. It's one of those we just have to wait and see things. You'll notice there's some changes to the treatment of times when a property is not an owner's home. We're going to talk about that in just a few moments. But just going back down to some of our examples, how is this going to work? Well, these are actually quite helpful. So you can see here, Mania buys a property in 2022 for $800,000. It's not a new build. In this instance, she uses it as a main home. In other words, she lives in it. In 2028, she moves overseas and rents it out. In 2030, she sells the property for $1.1 million. Now, because it's not a new build in this example, her bright line period is 10 years, and she sold it within 8 years of buying it. And so there's a bright line thing that applies. Now, this is where sort of one of these other changes comes in as well. Previously, you could have one main home at any one time, and if you sold a property, you could sometimes use the main home exclusion to not pay tax under the bright line test. What ID are now saying is, well, actually, if you rented it out for a while and you sold the property within 10 years, then you have to account for that portion that you rented it out, and there'll be some tax to pay on that. And the example here explains how that works. But if you just look down a bit here, we've got this little one here, property sold within 12 months change of use. This is a hypothetical situation where somebody essentially has moves into a new family home. That becomes their main home. It takes them 9 months to sell their old home for some bizarre reason. But the key thing here, it says the time between the change of use, i.e. not main home, and date the property was sold, it's less than 12 months. Lily does not need to pay any tax on gain of value. Now look, we're just running through this very quickly because we don't want to leave you sitting here on a webinar till midnight. But the point is, if you're feeling a little unsure, work through the examples. They are quite good in helping you to understand how the law applies. If you're still unsure, by all means, contact us, and happy to help you understand your situation. We'll just stop that share for a moment. So our key takeaways from that are what? Bright line increased to 10 years except for new builds, which remain at 5 years. The main home exemption has been changed. So now you have to pay tax on gains made for periods when the property is not your main home. And that's what this change of use rule is. Now, the other big change is property owners are not allowed to claim interest on loans used for residential properties as an expense against the income from those properties. It's going to start from 1 October and be gradually phased in over 4 years. So by the end of it, you'll be paying interest perhaps on your rental, but you can't claim it. So let's just have a look again at the other fact sheet, which has been published on this. Here we are. So this, again, as you see, it's on the IRD website. The links are on EpsomTax.com/blog. Interest deductions, proposed changes. Now, it's been described as proposed. simply because it hasn't become law yet. But we imagine the substance of this will stay the same. So the question is, well, how does it all work? Well, we've got a great little chart here on the second page here. So you see it mentions, it's talking about income years. So the year that ended March 21, that's FY21 accounts we call it. You can claim your interest as normal. The year that's coming, it ends in March 2022 or FY22. The average reduction is going to be 12.5%. And then the following years, you can see you can only claim 75%, then 50, then 25. So by the time we get to FY26, which is the year that ends March 2026, there is zero claim on interest. Now, the exception to this is new builds. It's not on the ID website, but on the Labor Party website, it's come out quite clearly and said that these interest deductibility rules are not going to apply to new builds. And we'll hear more about that at the very end of our webinar from Daniel Carney. So again, we've got some examples on how that works. And this is probably is quite a big deal if you're thinking about restructuring. Just stop the share there. So say, for example, what you would traditionally do is maybe you had your family home, you bought a new family home, family's growing, you need a bit more space. Now you end up with a situation where maybe you had to pay 1.2 million for your new family home, and the one you were living in, let's say you'd bought that for 600,000. So now you end up with this big mortgage of 1.2 million on your family home, and your rental property, you know, she says, well, I don't want to sell it, I want to just rent it out. It's got the smaller mortgage. So what we would typically do is set up something like a look-through company. It would buy the old family home at market value. It would get loaded up with debt then, because we assume the old family home that you bought for 600K now, that's gone up to maybe 800, 900, something like that. And effectively, though the overall debt doesn't change, you could reduce the debt on your family home and increase it on the rental. Now, that strategy still works, but the problem is that change of ownership now would subject your old family home to the 6-month rules. In other words, you can claim that increased interest, but only up until October or September of this year, and then zero. So for a person who's in that situation, you better not restructure. That's going to cause you some serious problems. And it really need to be a little bit brutal about the rental. We are creatures of emotion, and we might think, oh, but it was our first family home, we don't want to lose it, and maybe there's valid reasons why. And you know, again, at the end, very end here, we hear a presentation from Daniel Carney of Goodlife Advice, you know, sort of arguing, well, look, if you end up having to pay some tax on your rental, but in the big picture you make 500 grand, well, what's sort of 50K tax? It's 10%. It's kind of neither here nor there. So there's some arguments around it. But we're also encouraging, as we're going to talk about shortly, folks to think about sort of not being emotional. Get your advice from your financial advisor, from your mortgage advisor, from your property accountant. Maybe it's time to sell that and get a new build instead, and take advantage of these tax concessions that the government is going to give to new builds. Now, the other change that we just want to point out is ring fencing rules have been applied to short stay accommodation. So previously, maybe you had a loss arising from your Airbnb property, and that wasn't ring fenced. You might be able to get a benefit, a tax refund on your personal tax return from that. That's been ring fenced as well. So possibly to stop people just going, oh, well, we'll stop renting our property, and a big move into lots of Airbnbs. Some rules which were already restrictive have just been made more restrictive. So there has been, I must admit, in the last 2 weeks, you know, some anger come out. Why is this happening? Well, we're certainly going to make no political comment on it. We're politically neutral, but it would appear that the government would like more new houses to be built. And so how do they do this? Well, you know, in some countries, they want less fossil fuels. And so if you buy an electric car, like in the States, where you get a federal tax credit of maybe $5,000, $7,000, $8,000. Oh, well, I'll buy the car because suddenly you got, you know, $7,000 or $8,000 cheaper. So, you know, governments will often use tax schemes or incentives to push citizens in a particular direction. And it may well be that this is the thinking here too, right? We remove the tax concessions from existing housing stock, but we leave them around new houses. What will investors do? Well, that should push them towards building more new houses and help with the housing shortage. So, the government, perhaps stepping back from it emotionally, one can see what it is that they may be trying to achieve. So let's just have a look at a worked example, and then we're going to talk about some strategies to deal with that. So we're going to have a look at an example here. This calculator on the left, this is on our website here, and you can download that again from EpsomTax.com/blog. Now, it's password protected. The password is 1914. The reason we put that in is just that if you don't know what you're doing, you can break the formulas and they don't always work as well. But you just go up to review and then unprotect sheet and enter that, and you just need to do it for each sheet. Now, what I've done, this is an actual client's financial statements on the right. I've just removed any identifying details. And we're going to do a bit of a projection to see how these new laws are going to affect them. So here we can see this is FY20, and we've just finished FY21 a few days ago, right? So those accounts haven't been prepared yet. Obviously, we're only 9 days into the new financial year. And we're making a projection then for FY22 and the following years. So we're going to assume that for FY22, so that's the year we're in now, that this person's going to get $500 a week rent. And you notice these increases here. This here, 550, for example, you can see the formula, it's 52 times 550, and this one here is 52 times 575. I've just added $25 a week, but you can adjust that as you like. Costs recovered, we've put $750. Now that's typically when you charge your client water rates for their usage, and they pay their usage back to you. That's what that is. Now this particular person doesn't have a huge loan. It's only about $385,000, so the interest is not a big amount, and they've got a great rate. It's 2.45%. Now, one thing you'll just notice here on the sample financials is that in 2020 their interest was $14,770. Why was it so high when we're talking about $9,500 for FY22? Well, essentially they were on a bigger rate, and it was fixed, and they've renegotiated, and they've managed to get it down. So definitely that's something to do. And we've got Rupert Goff coming on from the Mortgage Lab, as we said. He's going to talk to you about break fees and other things like that, and whether it's worth that if you're stuck on a higher amount like 4% or something. Now we've just populated some other fees in here, made some assumptions, accounting, depreciation, a bit of home office, insurance, etc., etc. These boxes here allow you to put annual increases or decreases, and as the case may be. With the rates, I've got them at 7%, and that's probably quite conservative. Our rental rates are going up $300 a year quite easily. It obviously depends where your rental property is. But what's the end result? Well, this profit line here, this is what it looks like if no changes had been made by the government. So $27,000 comes in, 20 grand goes out. You've got a profit margin here of about 6,600. But we remember in FY22, they're going to make a 12.5% reduction on the interest you can claim. So we've put that in there, and here's the new result. Now you notice the sort of red figure, loss carried forward. In this case, this person's got about a little bit of loss. You can see it's highlighted with the arrow from a prior financial year. They may have a bit more from FY21. Let's just assume that they've got, say, $500 loss from FY21. We'll put that in. And it does reduce their taxable income just a little bit there. So this is a sum box, as you can see. It just adds up all those figures. What's the tax impact going to be? Well, you can see for FY22, they're going to have about 2 grand tax to pay. Oh, so yeah, not the end of the world. But what happens as the years go past, and we're assuming rents are being increased and costs are increasing in line with inflation or other things. Well, you can see the taxable income steadily goes up. from 7,000 to 10,000 to 13 to 17. By the time we get to year FY26, this person has got $6,000 of taxable income coming off their rental. And just as a point, if your end of year tax is $5,000 or more, then you'll become a provisional taxpayer. So on top of your wages and taxes deducted from that, you're going to have to start paying tax in August, January, and May of each year, provisional tax payments. So this situation, this particular person, we would probably say, well, it's really, you want to seriously think about selling. When you're out of Brightline, maybe if you're out here, it's a good time to think about selling in FY23-24, just making sure that you're not going to be caught by Brightline and that there's not going to be tax from rezoning changes or other things like that. Now, what we're going to do here, I was just bringing up the next thing on screen, is look at a different example. So here we can see something quite different. We've got a situation where the rent is about $40,000 a year. Loans are much bigger. This is perhaps quite common, say $800,000 worth of loans. There's a lot more depreciation going on here. Now, ordinarily, I'm just going to delete this box for a moment. Ordinarily, we would have a situation where this kind of looks pretty bad. In other words, their taxable income really increases because of these changes. However, this client happens to have about $35,000 worth of losses from FY20 and FY21. So with them in there, and it's in that yellow box, you can see that, you know, they carry the loss forward to next year, and then there's still some left over. So they carry forward to the year after, and there's still some left over. So really, they're not going to experience any impact from these new changes until FY25. And then things really change, of course, in FY26. So this person, like most of our clients, has actually got sort of a good 3 or 4 years before they feel the impact and to decide what they're going to do. So yes, by all means, download the calculator, have a play with it. If you break it and something doesn't work, just download it again and re-enter that password if you want to just adjust it a bit and take some of those protections off. This moves us to the next phase of our discussion where we just want to talk about some strategies. And we've actually got 8 strategies that we're going to highlight to keep in mind. What should you do? So the first thing is don't panic. As we said, most investors have got losses from previous years, from FY20 and FY21. They've been ring-fenced for 2 years, so they wouldn't on-flow and give you a tax refund. That's turned out to be a handy thing because now you can carry them forward and offset them against this. So for most people, the tax impact is deferred for a couple of years, giving time for you to see where the law is going to sit and what changes need to be made. Just keep in mind too, that quite often when new laws are made, there are unintended consequences. Then they have to make more laws to fix the consequences. That happened with the LTC regime when that was introduced. It took a couple of years to get sorted. Some people found themselves in some very unfortunate and unintended circumstances. We expect the same thing to happen again, sadly, with these changes. So it's good for if you can have a bit of time for the dust to settle and see what happens. Second strategy, consider selling your existing rental and getting a new build property. So that's something definitely to have a bit of a think about. Third, look at your budget. You know, it might be, I was talking to a client yesterday and they said, look, worst case scenario, it's going to be another $10,000 a year. So that's going to cost us $3,000 tax. In the big picture, we can afford that. It doesn't change our overall strategy. It's just not going to be quite as lucrative. So, you know, budget for it, you know, look to see, okay, in this situation, what's it going to cost me a year? A fourth suggestion, do look at raising the rents. to help offset that reduction. Remember that rents can only be raised once a year now. So you can give the notice at the 10-month point. You've got to give 2 months notice. And of course, always err on the side of caution a bit. Perhaps it's better, rather than doing it exactly on day 365, just give yourself a little bit of a breather. As a landlord, you're always weighing up, well, look, I've got good tenants. We hope you have got good tenants, and I want to keep them. But on the other hand, I'm also, now my property's getting more expensive because, you know, this deduction is being taken away. So it's a difficult one. And, you know, certainly we're sympathetic to that. You know, we rented, many of us perhaps rented for years before we were able to get into home ownership ourselves. So, you know, we don't want to forget that. And we're sure in general that, you know, New Zealanders are not mercenary about this. We should understand those difficulties. So it's a difficult balance to, you're trying to run a business. It's not a charity, but on the other hand, you're also thinking about people, and you don't want to be mean to people or unfair either. One thing we would probably suggest is, rather than just leaving it for, say, 4 years and then doing a massive hike, that's kind of not really fair either. You're better to do smaller annual increases than one dirty, great big rent increase, which will just about give the tenant a heart attack. A fifth suggestion, we would say to consider selling heavily debt-laden properties. You know, look for something that's more cash flow neutral or cash flow positive. Now, of course, you know, you still can offset positive properties against negative properties, i.e., one's making a gain, the rent is more than the expenses. One's making a loss, so the expenses are more than the rent coming in. You can still offset one against each other. But as interest deductions are going to be gradually taken away, that's going to change. So it means that property portfolios need to be rebalanced. And of course, if you're going to sell a property, make sure you check with your property accountant first to make sure you're not going to be caught by any of the myriad of laws which will catch you if you're not careful. Our sixth suggestion, our sixth strategy is check whether it's time for a restructure. It may be restructuring just for tax. Well, one has to be extremely careful, because you could then leave yourself open to being accused of tax avoidance. But you know, businesses genuinely, you know, there's life changes, there's business changes, and so restructuring at times is appropriate in order to address those. You know, again, that's something to undertake carefully. At one stage, we saw a client who had written to the IRD and said, oh, please revoke my look-through company election and make it a normal company. What they didn't realize is that would trigger taxes on exiting that. And so a bit of a nasty headache. So it's always better to consult with your property accountant beforehand, because there's a lot more gotchas than there used to be. Point 7, it's worth looking into commercial property, as that's not subject to these new rules. But, you know, again, caveat emptor, commercial property has not always been as easy to get into. The risks are often higher. The repair bills are often higher. And especially over the last year, we've seen what happens when suddenly businesses are locked down. They can't get in there. People aren't buying. Now they can't pay the rent. We've seen some landlords who've been mercenary and insisting on their rent, despite the fact that there was no income. And we've seen other landlords who've been more understanding. But we say mercenary, we don't know, again, what bills that they themselves are having to pay. So it's not a get out of jail free ticket, to use a monopoly term, as it were. Just like anything else, commercial property has its risks too. But definitely something worth considering. And remember, a balanced portfolio doesn't have all its eggs in one basket. It's spread over different forms of risk. And our 8th point is it's worth looking into short stay accommodation. Of course, Airbnb is what comes to mind, you know, book a batch, etc. There are rules around deductions. For example, if you have an Airbnb and it's empty for 62 days, you know, 2 months or more a year, and you stay in it at times, well, it'll be deemed a mixed use asset, and then you have to start prorating your expenses and so forth. So that's also not either necessarily the easy route. There's restrictions around there. There are some other strategies as well, which we're not going to discuss in this webinar, and which we invite you though to contact us if you want to have a chat about some other strategies to do with investment property. So a couple of FAQ before we move into comments from Rupert Goff, and then our Q&A. And we've had some questions that have been coming in tonight through the chat, so we'll answer those at the end as well. So main questions: what can I claim? Well, you can claim all the usual costs that you would claim, you know, property management, repairs, maintenance rates, etc., etc. This change is affecting the interest on borrowings, and as we've seen, it's going to depend on timing. I'm referred to that chart. It's on our blog as well. How do I work out the tax impact? Well, as we said, use that calculator, pop your figures in, do your best there, and do feel free to send that through to us if you need a bit of help with that. Here's another question that has been a popular one over the last 2 weeks. My rental was a new build. Does it still qualify as a new build under these laws? In other words, let's say, you know, it was a new build in 2018 and you're wondering, well, is it still a new build now? Look, we think probably not. If it's already built, unlikely. If the construction is not complete, you know, well, ID haven't said, and you know, there's varieties of that. One is it's just a slab, or it's a slab with some structure on it, or it's actually got tenants in, but the CCC, the Council Code of Compliance, hasn't been issued. What about the situation with those? Well, we just don't know, unfortunately. We have to wait and see until ID provides some clarity on that. When did I acquire my rental property? Because when you acquire it is the big thing. Well, there's some definition on that, but the main date here is 27th March, and there's a little bit of detail around 23 March. Jump onto our website, EpsomTax.com/blog, and we've got a little bit more detail, and then even more detail with a couple of links. My property sale will be taxable due to the bright line test. Can I claim the interest costs? In other words, let's say you haven't been able to claim the interest, it's been progressively denied you as the years have rolled past. Now you're going to sell the property, it's caught by bright line. Can you suddenly claim all of that interest on the sale? How would that work? Well, let's say you're going to sell the house and you would make $500,000 on it, and you had perhaps $50,000 worth of interest that you weren't allowed to claim. Will the government then let you claim that $50,000 off the $500,000 profit, thereby reducing the taxable income in this hypothetical scenario? Well, the answer is we don't know. It has been mentioned by the IRD, but it was not categorical that this is definitely going to happen. It's just the IRD have said the government will consult. So again, it's a wait and see. The draft legislation will be out by 1 October, we're told. And lastly, how do the main home changes work? It actually just reminds us a little bit of how CGT works in Australia. And there's a really good example that the Stuff website put together. And you'll see there's a link on that blog post about that, which explains it in simple terms. So what we're going to do now is invite Rupert Goff. He's the CEO of TheMortgageLab, and Rupert's team have worked with many of our clients, and you'll probably see his posts on OneRoof, which is often quoted in the New Zealand Herald. TheMortgageLab has an excellent presence on social media, on LinkedIn, Facebook, Instagram, and so forth. So we're really happy to have Rupert with us tonight, and we look forward to what he has to say. Take it away, Rupert.